Hello everyone, thank you for joining us. So we've got a pretty good special guest joining us today for giving us a bit of an insight across a real estate market in commercial areas and other opportunities within the markets as well. Today we've got Chris Bedingfield. He's a portfolio manager at Quay Global Investors. He's got over 30 years experience working as a real estate specialist with the background in investment banking, in management, equity research as well. Prior to Quay, you were in 2013, you worked as a senior member in the real estate investment team at Credit Suisse.
That's right.
And previously led the real estate research team as well in Deutsche Bank. So you're a man of a long experience, I see. So we're quite excited to have you here. So thank you very much for your attendance. So we're really keen to sort of share some of the good insights of the recent market with our clients, and we're really keen to hear your views on a few things. So if you could maybe to start off, take us through some of the styles and processes, and what are the most important things you consider in the Quay investment fund when you're buying and selling or holding stocks as well?
Yeah, so, well, first of all, thanks for having me.
Thank you.
It's great to be here. So I think when we think about real estate, we think most real estate's very commoditized in its nature. And so while it's very, a lot of real estate sort of people will think about comparable sales when they think about investing, and that's natural. You're going to buy an apartment. You want to know what the one next door sold for, and people use that as a benchmark for their own investment decisions. And a lot of people do that. We're a little bit different. So we don't really rely so much on comparable sales. We think more about replacement cost. So an apartment might sell for $500,000, $600,000, $700,000, and that might give you some comfort to pay a similar price. But if they only cost $250,000 to build, we tend to stay away from those sorts of things. So we don't rely so much on comparative sales. What we like to do is we like to buy good real estate, well managed, low gearing, but when we look at the company, we look at the valuation, we look at how many apartments we're buying for how much market capitalisation we're paying for. So we try and dilute it all down to a price per door or a price per square metre and compare that to replacement cost. That's really the cornerstone of what we try to do.
Fantastic, thank you. And so, I guess at the moment we're seeing quite a volatile market, especially post-COVID and things like that as well. A lot of things are happening within the real estate, not just real estate, but across various sectors. So from your, as a fund manager's perspective, what are some of the global themes that you see, and what are the tech advantages out there that's available, and what are the things that you currently try to avoid at the moment on back of all that?
Yes, it's a good question. So if you go back through the middle of COVID, the big theme was data and also logistics. So logistics companies, industrial, I guess, did really well, and data centres did really well, and other sectors did pretty well, like an area that we're very bullish on, self-storage. So really those sectors that were non-communal in nature. So that was the big theme last year. The big themes now that we have a vaccine rolling out, and hopefully we'll have COVID behind us, the big themes now are in, I guess, what we would broadly call the reopening sectors of real estate. And so that would encapsulate hotels, it encapsulates office, retail, and also coastal apartments. So apartments traditionally are quite defensive, but what we've found this time around is that the fear, and we think it's an irrational fear, but they're a fear that people are going to drain out of the big cities and go and live, out in the bush or on the coast or whatnot. And so we are seeing really interesting opportunities in apartments in markets like New York, San Francisco, Bay Area, Seattle and the like, where, again, we think we're buying these apartments below the cost to build. And taking that long-term perspective. So they're the sectors that are interesting right now, but we always have an eye on price. We always have an eye on value. Just because a sector is a reopening trade, it doesn't mean you should be there. And even in retail. So in Europe, for instance, where it's not reopening right now, where the fiscal response by the European authorities is nothing compared to the US. We're very cautious about reopening sort of trades there. So it's not a case of just being in those sectors. You've still got to pick the right stocks, pick the right valuations, pick the right geographies.
Yeah. I did see in even in Australia, the New South Wales coastal line rental vacancies dropped quite to a 0.01 or 0.1 or something like that. It's unreal numbers, and property markets here in Australia and residential dwellings as well is obviously quite high. So it's quite interesting to see. That's obviously not just from your perspective, which is not obviously focusing just Australia, but you look at opportunities globally to sort of compare that and work through some of the value metrics there, which is really good to know. I guess, it's just back of COVID, and we briefly spoke about this before we sort of started recording this as well. But, I guess with sort of reopening trades and things like that, but the main concern a lot of investors are having is probably just around offices or commercial offices where post-COVID we realise a lot of employees are not returning back to the office, even still in Australia, despite COVID concerns are almost, not much here left. The big organizations spend quite a lot of money allowing employees to work remotely, work from home type of thing, flexible working environments all kicking across the big firms. From your perspective, is that a bit of a challenge from a long-term thematic going forward, or is that an opportunity for you to consider?
I guess it's a challenge to try and figure out how are we going to behave as workers going forward, because everyone has a different view on this. I think there is attraction working from home, but at the same time we're social beings, and there's also the argument to say, well, if some people are coming into the office and they're having a beer with their boss after work, is that person's career prospects better than the person at home on the Zoom meeting, working away? And it's a really difficult one to answer. And I think that's where our framework gives us a big advantage. Instead of getting too caught up in the weeds, again, we just go back to valuation. And if you get the valuation right, you might still get the stock wrong, but the downside's limited. And so for the last 5-6 years, we have never owned office, and now we are. So people used to raise eyebrows when they looked at our portfolio. So you don't own any office. Now they're raising eyebrows, going, "You're owning office." It's quite surreal to some extent. But to give you an example, so the one that we own in the United States is a company called Empire State Realty Trust, and as you can imagine, it owns Empire State Building. And about 1 million square metres of mainly midtown Manhattan office properties. So ground zero for COVID. We think it costs $600 to $800 a foot to build an office tower in Manhattan. We are in at this stock at around $320 a foot, so well below the cost to build. So the question to us then becomes, so long as we need to build in Manhattan again at some point in the future, and we can come to that assumption in a minute, but if you do have to build in Manhattan, we are going to make a lot of money between now and then, because developers won't build unless prices get to that point. So we'll at least double our money, maybe even more. And now, that might be delayed because less people are going into the office, but that's okay. Because even if it is being delayed, we know the cost to build is going up by 2, 3, 4% a year. So it might take longer to get back to replacement cost, but by then replacement costs might not be $700 a foot, it might be $1,000 a foot. So we can anchor in our better than CPI outlook, minimise our downside, and at the same time get 5, 6, 7% yield while we're waiting. And that's really the way we think about it. So, without getting too caught up in, what a rent's going to do, what a cap rate's going to do, how many people are going to come into the office, so long as you're buying below the cost to build and you're confident that you will need to build again in the future, that's really enough. That's really what you need to know. And then overlaying all of that, because we don't know how long it's going to take for the markets to recover, the next level is make sure you buy a good balance sheet. Because office rents are going to fall, vacancies are going to rise. You don't want bankers knocking on the door asking you to sell buildings at the low or asking you to raise capital at the wrong price. So lining all those things up, there are opportunities in office, but again, you wouldn't do it across the board, you've got to be quite targeted.
Yeah, okay, fantastic. That's really good insight, in fact. And lastly, to wrap things up, and this is something that I'm also sort of watching closely, and a lot of clients are asking these questions as well, is that real estate market, when it's traded in direct property market, obviously it trades at a 4% cap rate or 4.5% cap rate. Some of the same asset that is listed on the market on ASX, for example, they're trading at a much more discounted way, 6%, sometimes 7%, depending on what sector of the office they're in. That sort of divergence between the real market transaction and listed market transaction, what do you think that happens, and is that always the case, or does that normally come back to normality and catches up, and is that an arbitrage opportunity for some clients?
It's almost always different. The listed market is very prospective in looking forward, and so you generally you look at the market today in industrial, in logistics, the listed market's trading way above the physical. And then in apartments, we were talking about a moment ago, you're quite right. The residential market in the United States is going crazy. The buyer market, it's a bit like Australia, but the apartment market in the listed format is down. And so you do see these anomalies quite often, more often than not. But you've got to be a bit careful in that you might think that you're buying cheap relative to the physical market. But what's really happening is you stay cheap and the physical market falls and meets you. And that's what happened to a lot of people in retail over the last 4 or 5 years. They looked at retail values here, they saw the listed values here, they were buying it, and you would see, instead of the price going up, you'd see the physical come down. So that's why it always is a signal of where you may be thinking about allocating your capital, but you have to come back to your own fundamental framework, and that's why replacement cost, and I keep saying it, it's always that anchor, it's that cross check to say, okay, well, I'm at a discount to the market, but I'm still above replacement cost. It's not cheap. You know what I mean? So you've got to have that valuation framework and that discipline. Right. But you're quite right. The disconnect's there. It's always there. It's always interesting to look at. But just because you're buying a discount to the physical, it's not necessarily a good idea. And conversely, just because you're buying at a premium to the physical, it's not always a bad idea either. You need other framework, you need other tools to make those investment decisions.
Yeah, perfect. That's great. Thank you for sharing some valuable insights. We appreciate, once again, you being here. So Brisbane is sometimes it has been a rare place for visits, back of travel restrictions we had, but we look forward to continuing our relationship with Quay and hearing some more insight hopefully in the future again.
It's been great to be here. Thanks a lot.
Thanks, Chris. Cheers.